Guys, these are 5 stocks that our Inner Circle community members have talked to us about. This is great because Mo and I haven't seen any of this yet. We're pulling it up for the first time, and these are people in our community. Stock number 1 from Real Nick P, DEO. Now, what we did was we pulled their comments and then their stock analyzer analysis, and we're going to look at them, see what we agree with and what we don't agree with. Here's what Real Nick said. I bought the stock for the same reason Buffett bought Coke at a PE of 30 early in his career. I purchased Diageo, this winner, with a PE of 20. I love this, guys. Sprite mixed with Crown Royal is one of my favorite mixed drinks. So he sat there and said, listen, I have a personal affiliation with this company, but he still wants to see what's the right price for this company. All right. Diageo is similar in comparison to the Coke industry and one that is a staple to consumers across the world. So my first opinion on this, guys, is I get why he said Buffett and Coke. And I look at this going, but when I go to a restaurant and I have people asking for alcohol, if they don't have the liquor they want, it's not like they're like, oh, I can't drink. Like, but with Coke and Pepsi, you better believe if somebody goes there and they don't have, it ruins my meal. Now, I have my personal bias there, but I'll see people say, I'll take a Diet Coke. I don't have Diet Coke. Yeah, I'll just take water then. They won't take the Diet Pepsi. Yeah. They won't do these things. And that to me is a lot different than Diageo.
Because it's nasty.
What's nasty?
Pepsi.
Listen, I used to be a Pepsi guy. I actually like it still. I prefer Diet Coke or Coke Zero, but I'll still drink Diet Pepsi. Now, my favorite thing about this company, it's one of the world's largest producers of wine and spirits. For short, it's a moat with many household brands, including Captain Morgan and Crown Royal. They do have those great brands. Yeah. Diageo has many brands that are awesome with it. I like where the company is headed with the new CFO, Johnny from Coke, beginning this fall. I'm fond of the $75 million effort to fund zero carbon, low cost power. Snooze. Listen, I'm not trying to be a dick. I don't care. And the reason I say that is they're going to do what they're going to do. But to me, that's not affecting my investment thesis. And it's been proven time and time again that ESG or whatever it's called investing doesn't work.
Even BP is backing off of it.
It's a great cost-effective approach to manufacturing, blah, 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 blah. So let's see his assumptions here.
Okay.
Mo, can you pull up the analyst assumptions just so we can get an idea?
Yep.
So he did this on his app. Our app has all of our software on there, the community stock analyzer tool. He probably did a 10-year analysis, guys. He did 3%, 5%, and 7% revenue growth. What are analysts calling for?
So it's all over the place. June 2024, $27.3 billion.
Yep.
At the end of 2028, June, 26.73.
Wow, flat.
Yeah. There's a year where it spikes up to 44, then it comes right back down to 25 and then 26.
So why are analysts calling for flat or down revenue and they're calling for 5% mid? Mm-hmm. I don't know. What do they know that we don't know? What do they see that we don't see? Yeah. Are they selling off divisions? I have no idea. So off the bat, I'm like, remember, I went in this blind. I have no idea. Mo, can you think of an idea why we would? I do think like the cost, the revenue probably can go up at least with inflation. Cost of living, inflation, nominal GDP growth.
Yeah. I mean, this is basically, if you go up 5 years based on what analysts are saying, it's going to be declining revenue.
Okay.
So
now profit margin, pretty consistent. 20 to 22%. So he did 20, 21, and 22% for profit margin. Now free cash flow, significantly lower than the profit margin. Basically 17% on 5 and 10 year versus 20.5 to 21.5 on this one. I think he went a little low on this. I think he urged a set of caution a little bit too much. Yep. So I think he's being conservative here. PE 15, 20, 25. I'd agree with that. I mean, look at the ROIC. It's increasing over the years. So far, the only question I have is why this? In terms of being more conservative, why that revenue growth number? Desired return, he put 10, 11, 12. So he put in some margin of safety there. And guys, look at this. Look at his numbers. He's got a low of 50. Let's focus on earnings. He's got a low of 109, a high of 193, a middle of 150, and the stock's currently at 140. So I get it. But to me, the main question I have is, what's this revenue growth? Yeah. Why do they show for equal versus lower?
Go and see what the path forward looks like, what the company is saying, get other people's opinions.
Absolutely. So Nick, thank you very much. Stock number 2, from Thorify, who we know very well. He's very active in our community of insiders. We love it. He talking about MELI, Mercado Libre. That means, is it free store? Something like that. Mercado Libre operates the largest e-commerce platform in Latin America. I believe the emerging middle class of Central and South America will cause their revenues and free cash flow to compound each year. I do not disagree. mean, Mo, we have houses in Mexico. We can go down there. We see the poor getting better.
Yep.
We see more and more Mercado Libre. When I bought things for the house down there, I'd order on Mercado Libre.
Yeah.
The store manager would get it shipped to him. Everything would be fine.
Mm-hmm.
Great. They also offer shipping solutions, payment and financing, advertising, classified ads, and turnkey e-commerce solutions similar to Shopify. The revenue is generated through several diverse channels, including final value fees, advertising royalties, payment guys.
And that's all going to get better.
Yes, it's only going to get better. It's Amazon of Central America. Yeah. Let me guess. I could see Amazon buying this thing at some point.
Definitely.
Right? If they're eating up enough of if Amazon's like growing, and they could sit there and say, listen, maybe we just eat up this company, buy them. So some challenges for the business are their exposure to emerging markets with higher inflation. I don't think it's a challenge. I think it's a positive.
Mm-hmm.
When you're making money off revenue and inflation jumps up, and that means your cost of the cost of goods can go up, you're going to get more revenue. Yeah. I don't think it's a challenge. I think it's a good thing. Cyclical portions of their business, such as consumer credit and their ability to recruit talented developers, may be limited. Again, I don't agree with that. I think the talent down there is great for developers. One company we used to use for development just opened a huge office in Guadalajara.
There you go.
Guadalajara. 50 developers down there, just north of our town of Manzanillo, that we have 2 houses down there. Yep. So I'm looking at this saying, Thorify, I think all your negatives are positives. So let's see his assumptions here. Now, Mo, he did this on desktop. Okay. Able to send a nice little screenshot. Revenue growth. He did 13, 16, and 19. I love this because look at the previous 5, 5, and 10-year numbers. Way higher than those, but he didn't go off that. He sat there and said, listen, I'm fine with this. Mo, what do you have for revenue growth by the analysts?
They have about 20% revenue growth.
Okay, so he's being a little conservative here maybe. Yeah. Profit margin, he stuck to 4 across the board. Look at this, Mo. Free cash flow, 20%. Profit margin, 4%. Wow. So they're spending a lot on growth probably, which gets depreciated over time. But if there's free cash flow is after capital expenditures. So I want to understand, guys, we love it when free cash flow is better than profit margin. Yeah. So I'm going to focus on free cash flow here. PE, he did 23, 24, 25 for both PE and price of free cash flow. Now, what's your take on this, Mo?
I think I'd go a little bit lower on the low end.
I'd go lower probably across the board, but more importantly, I'd probably have wider ranges. Yeah. I wouldn't have them this close. For me, I would do something for this company like
16, 20, 24.
I was going to say 17, 20, and 23.
There you go.
That's my opinion. That's the only thing I would say about that. And desired annual return, 11, 12, 13. It's another country.
Yeah. A little margin of safety.
Yeah, I think maybe a little bit more for me. I'd probably do 12, 13 and a half, 15. Maybe 12, 13, 14. I don't know. But look at his values here. It's at $17.40 per share. Based on this kind of cash flow, it's green across the board, Mo.
Yeah.
Look at that.
That's interesting.
You know, I always ignored Mercado Libre because of this. I looked at the PE.
Right.
Maybe it's something for me to look at. So Thorify, I think you picked a great company to look at. You know, obviously I recognize your name because we talk all the time in the community. So I really appreciate you engaging on this one. But let's go to stock number 3. Now, guys, before we get in stock number 3, this is not even 1%. This is 0.1% of our amazing community. These guys here are able to talk to each other. They do this kind of stuff with things to each other. Go join the community of like-minded investors. Get a hold of your emotions. Be able to get input from people on different investments. You all have ability to cut and copy and paste your own screenshots, everything like that to get in people's input. It happens all the time. Click the link below. Check it out. We have a great trial. I guarantee that if you join the community and use all the tools and get in control of your emotions, you will make better investing decisions. And that's the whole goal here. Everyone buys individual stocks. They want to beat the market. You can't do that unless you have a good process coupled with great emotional tolerance and ability to handle that. So Chris, market cap, he's looking for Stone, STNE, market cap around $5 or $6 billion. They just reported earnings. The price is dancing around. Just reported earnings doesn't really matter to me. Brazilian company that's a credit card provider. Think Visa for Brazil, but they have other offerings of software and banking they want to offer their clients so more business is done with lower acquisition costs. Think merging QuickBooks banking loans with a credit card. He was tracking the stock in 2021. Buffett owned it then, or at least Berkshire did. And then sold a portion when the share price peaked around 90. What's it at right now, Mo?
It is at $14.50.
Wow. So decline, big decline. Big decline.
Today alone.
What was that?
It's down 5% today. Incredible.
It was curious due to Brazil mandating more cashless transactions where Brazil was historically a cash-based. Guys, Economies, as they develop, become less and less cash-based. As they become more and more advanced, they're going to do more digital currencies. I'm not a fan of their plans to expand and offer banking and loans. I get that. I actually don't blame you for that. The loans kind of get a little tricky with balance sheets and how you have losses, and emerging economy like Brazil, they are more volatile. I wonder what interest rates are in Brazil anyhow. Like I look at Mexico, you borrow at 10 or 11% to buy a house from the last time I checked a few years ago. So, we complained about 7 or 8%, and they were at 11%. We were at 3%. So, it's every country is different. There's probably some battles with inflation. The thing he likes about it is 10 times free cash flow for 40% growth is very nice. He even wrote Borat voice. I like that a lot. Very nice. So let's go check this out. Let's go see his assumptions here. All right. So not a lot of history, but he did a 5-year analysis, not 10-year. He did 5-year. He did 9, 11, and 13% revenue growth. Mo, what do they have for the analyst assumptions?
High single digits, probably 7, 8%.
Okay, so he's a little bit more aggressive, but that's okay. Profit margin, he did 15, 20, and 25. Look at this free cash flow, significantly lower. So my first question is, why did you put 20, 22, and 25 for the free cash flow when it was so far different? That's a big question I have. PE, he put 15 across the board. Same with price to free cash flow. I think you reserve 15 for like average companies. I think you got to give a range here, because I think you have to give a higher range if the company does better than you expect and builds more of a premium. Don't you think, Mo?
Yeah, absolutely.
I rarely go and do the same PE unless it's like a company I know for like,
exactly.
Listen, Microsoft should be an X PE. I don't care.
Right. Like, this is not one of those.
Yeah. And he put 10, 12, and 14% in for his desired return. He got all green across the board here. Would I do it a little bit differently? Yes. Yeah. But the only major question I have here is this free cash flow. How is their free cash flow going to be so different? Because he even said they're selling for 10 times free cash flow when their current free cash flow is 66 times. Guys, stock number 4 from one of our users, David Daychris13. He wants Frontline PLC, an oil tanker company with a $6 billion market cap. So he was originally looking for a trade to make back when oil went negative a few years ago and stumbled upon oil tanker companies. And as I looked into them more, I realized there was an actual investment thesis for them. Okay, we all remember that. Remember when oil went negative for a while? That was pretty fun. Yeah. Currently, a large portion of the oil tanker fleet is over 20 years old or will be turning 15 to 20 years old within the next couple of years, which is typically when they get scraped. I think it might scrapped, and the current order book for new tankers is only less than 10% of the current worldwide fleet. This provides a favorable supply-demand imbalance for the tanker industry. Yeah, it makes sense. What I like is the operating expenses for the tanker companies are relatively flat. So as revenue increases, their profit margin increases dramatically. Now, guys, I want to go right to his assumptions for the business. And I'm just going to go right away and say this. Last 10 years profit margin, free cash flow, last 5 years and last year, all big negative numbers. Profit, huge positives. I am not even entering this business until I understand what that... Mo, have you ever seen that before?
Nope.
That's a huge discrepancy between free cash flow and net income. There could be a very valid explanation for it. Is there? No, actually, there couldn't be.
That's crazy.
There could be, of course, if they're building, but what are they possibly spending on? Let me pull up the company right now, actually in our software, because I want to see this myself and go, what is going on here?
Because it's not like it is based on oil pricing per se. It's the transportation of the oil. So it shouldn't fluctuate with the commodity.
Mo, in the last 10 years, they've had 2 years of positive free cash flow.
Yeah, that alone just makes me...
David, for me,
kind of move on.
I'm out.
Yeah.
Immediately, I'm out. And I apologize for that. I'm not trying to dismiss anything. But I look at the free cash flow saying, if you can't even generate free cash flow, the lifeblood of your business, how are you operating? And by the way, case in point, look at their shares outstanding, just increasing over time. It makes sense. You either got to, when you have losses, you either got to pay for, if you don't have the cash flow to pay for the losses, you got to pay for them with debt or with taking on more equity. I just look at this saying, I'm out on this one. Like, I'm not going to look even further on it. I am totally out. I apologize. It's a little dismissive, but that's the way I feel about it. Go ahead, Mo.
So they even pay a $638 million dividend.
How?
That's how.
Listen, you could probably, here's the thing about investing. You could probably spend more time digging this apart and say, no, there's value here. But for me, that's not the kind of business I want. So I look at this saying, David, if you want a business for a long, like if there's some sort of value play here on assets, more power to you. But I'm looking at every aspect of this as not something I want. bad free cash flow, increasing shares outstanding, bad ROIC. Go ahead, Mo.
And I just want to follow up on that dividend because the dividend is 10%. The forward dividend is 4.29%. Even at 4.29%,
how do you afford it? If you have negative cash flow,
make sure I got that in there.
Yeah, if you have negative cash flow, you can't afford a dividend.
Correct.
All right. So, the final stock, Sprouts Farmers Market by Baylor, one of our users. Guys, as you all know, I own Sprouts Farmers Market.
Me too.
Mo does as well. Don't buy a company just because we do. As you can tell here, I love the fact that Baylor sat there and said, listen, I'm looking at Sprouts. What do you think? Obviously, he watches the show. We're going to talk about this. I'm going to skip right to his assumptions because I want to sit there and talk about, well, the reason I like Sprouts is specialty company, increasing their own personal line, which has a much greater gross margin than everybody else. Their current profit margin is about 4%, which is over double the typical grocery store. Yep. They're small, only 380, 400, I think it's 407 locations, and they want to grow to about 1,250. So a long runway, great operating business, and they just brought in the former CEO of the 99-cent store, who's an expert in maximizing revenue per square foot.
Jack Sinclair.
So I've been lucky. Mo was lucky. We bought it in the low 30s. It's skyrocketed from here. And we don't say it as a humble brag. I didn't get my full position in. Mo did. So I'm very jealous of Mo. Add that to the jealousy I have of his $17 cost basis on Apple. And I look at this saying, okay, Sprouts makes a lot of sense. Let's go see what assumptions he made on Sprouts. So here are his assumptions. 6, 8, and 10% revenue growth. Okay, not bad. I think that's fine. I look at this saying, okay, they're going to grow their stores. They're going to grow same store sales, hopefully. That should be able to do that pretty easily. Yeah. Profit margin, 3.8, 4.42. Same with free cash flow. Well, I actually think that's low.
I think it's
number one. I think I made those assumptions.
I think it's low.
And I think I made these same assumptions because 20% of their business right now is their own brand.
Yeah.
That brand's got a 40% higher margin than the current stuff, and they're growing that brand as a percentage of their revenue.
Do you want to hear what my assumptions are?
Yeah, what are yours?
3.5, 5.5, 7.5.
Yeah.
Because I do look at that other brand that they're really pushing for, and that's going to increase their margin.
I would probably done 3.5, 5, 6.5, but yeah. I don't think that's wrong. Now, PE and price of free cash flow. We did this earlier. He did 18, 19, and 20. I like wider ranges. For me, I'd rather put 16, 19, and 22. Because for me, it's okay, if it's low, it's still a good quality business. If they don't grow as much as they thought, I'm still willing to pay that premium because they're a top quality business in a market, in a kind of industry that they can really still accentuate and differentiate themselves with. So I'm still willing to pay 16. And he did 9% desired return. He has a low price of 55, high price of 90, middle price of 71. I don't disagree. I just think it's too expensive right now for me to add any more shares. But if it fell by over 50%, I'd probably be adding more. So guys, what we've done in these videos is we've taken community members and we've sat there and analyzed their companies. If you want to be a part of that inner circle, click the link below. Join the community, join the inner circle. You'll be happy you did. Thank you for your time.